What we're seeing in the housing market, our thesis there, which we wrote a report last year highlighting this issue, and it's slowly started to unwind. We're starting to see median home prices start to tank in February and March. And so home prices nationally are starting to roll. There's still some bright spots in the blue cities. So nationally, they're starting to roll over, and that's 20% of the economy. New tenant rents started plunging in the fourth quarter of 2024 when Trump got elected. We believe that was due to self-deportations. Of the 20 million illegal aliens were propping up the rental market, which propped up the housing market. That extra flow is gone. Deportations are slow. They haven't really started yet, but the housing market is definitely under pressure. So that should filter in over the next 6 to 12 months as construction layoffs continue. There is some pickup from the data center spend, but we believe that's going to come to an end pretty soon as well. So our housing thesis is intact. Our China thesis is intact. We put out a piece recently showing that overall construction declined in the fourth quarter of 2025, and it's rolled over again in the first quarter of 2026 in China. It's down 8% year over year. This is important because the real estate crisis started in 2021 due to demographic declines and a massive 20-year overbuild. They have 20 years of supply. Their new home permits have declined 70%, and real estate construction is only down 20, but that's because they had long-lived projects that were ongoing. But this is now starting to affect the overall construction number for everything. And we think the acute phase of the crisis is coming, and that's going to affect global trade in Asia and eventually the US. So that's a contagion risk. The AI bubble looked like it was bursting in December, January, and February, and there was some signs that it was bursting, but we've got a recent last gasp blow off top, we believe, due to the IPOs and semiconductor shortages. These are blow off tops. We've seen this before in the dot-com era. And there are shortages, but shortages lead to gluts. And we think this is the last gasp, the last takeoff in the AI stocks. And there's a lot of narratives in the AI field that are coming out that show there is no ROI. Fortune put out an article saying businesses are not seeing the ROI from their AI. Bloomberg put out an article from the consultant firm Bain saying there's no ROI. And we think the narrative is shifting, but the price momentum is not stopped yet. We're in the danger zone here in the next couple months. So the AI bubble, we believe, is going to burst. The other thing that's interesting, Google issued $80 billion in equity, private placement, rather than using debt. So we think the debt markets are telling the AI companies that it's too expensive to use debt. So now they have to use equity. The private equity markets are under duress, and the private credit markets are effectively frozen. There's a lot of gating of private credit funds, and now there's redemption. So debt financing's gotten very expensive. Now they're going to equity. And so what we have for the markets is a very dangerous setup of AI fundamentals slowing, but the stocks doing the exact opposite at the moment. We have 3 major IPOs with lockups, so there's a lot of supply coming. And all the Mag 7, they're spending so much money, their stock buybacks are going to lessen. So we see a lot of stock supply coming, AI fundamentals shifting. We see semiconductor moves, like they're ending moves, they're not beginning moves. When you have Micron go from 60 billion market cap 13 months ago to 1 trillion market cap, it's unsustainable. Semiconductors are notoriously cyclical. So that's where we are. We think the stock markets are painting a picture that is totally false given what is going on in the real economy. 45% of the S&P 500 is AI or AI adjacent. All over the Twitter sphere and in financial newsletters, the CAPE ratio, the Shiller ratio, the Berkshire Hathaway measurement, it's a historical high valuations. And so if you were to get an inheritance and put your $1 million inheritance in the stock market today, you're likely guaranteed a 0% return, including dividends for 10 years, which implies a tremendous drawdown between now and then. So stocks are just too expensive, and everything has to go perfectly at this point for them to continue to go a lot higher. I'm not saying they can't, but I wouldn't own this with your money. I think there's a misunderstanding. There's this belief that China is going to overtake the US. And we've looked at the numbers, and China peaked as a percent of price in US dollars at 80% of our GDP in 2019. Since 2020, priced in US dollars, their GDP is 60% of the US. Their GDP growth since 2020, priced in US dollars, has been effectively zero. They've been printing 5%. So we believe peak China is in the rearview mirror. They have a demographic disaster, and now the acute phase of their real estate crisis is hitting. So, when Trump went over to China recently, and President Xi talked about that trap, saying that we need to work together and implying that US was the weaker economy, it's the other way around. They they're in deep distress, and Trump's tariffs on China are the right move because they're basically exporting deflation. They're in a deflationary death spiral, much like Japan was in the 90s. And the difference is that Japan exported their way out of that problem, but they are 1/10 the size of China. To make up for their internal downturn, they've been exporting like crazy since 2021. And that's why we're having trade wars. And the tariffs are affecting them. The dollar system is very ingrained globally. The yuan is very overvalued and they're depreciating their currency about 10% a year. So their trade partners probably understand that and don't want to have a whole lot of reserves of yuan. Well, look, you remember in 2024, there was a yen carry trade problem and they stopped raising rates, but it looks like they have to raise rates this time because inflation is going crazy in Japan. So my feeling is we don't want to see a yen carry trade problem. And that's why the US opened up dollar swaps to Japan when Iran war started. But we're getting close to Japan's reserves, oil reserves going the wrong way. And that could cause a balance of trade payments crisis. So we got big issues in Japan. The global risks are just so immense at this point that you got to be cautious here. And look, the oil price and the stock and the US market are telling you that a deal is imminent. If we do not get a resolution, the price of oil may go up quite a bit because the oil companies, the executives are saying that in 2 to 3 weeks, we hit critical levels in some of these strategic petroleum reserve funds, and that oil could go to 150. If oil goes to 150, it's probably going to 200, and that's a disaster scenario. If that happens, we see inflation peaking out in August, headline inflation at 11%. Scenario one, we had it peaking out at 5%, and that looks like it's in play. So we need a deal soon. And so if we don't get one, look out. The NASDAQ and Bitcoin have a strong correlation, historically 95%. Bitcoin is a risk-on trade. So Bitcoin needs to rally back up to make the correlation hold, or the NASDAQ has to move down a lot for the correlation to hold. So, and Bitcoin is on a global liquidity canary in the coal mine. So what it says to me is that Bitcoin is being sold to fund and chase, momentum stocks, particularly NASDAQ and semiconductors, which means the liquidity situation isn't as good as everyone thinks. Because if this was truly a liquidity-driven market rise, Bitcoin would be participating right now. It just doesn't bode well for global liquidity that Bitcoin is struggling, in my humble opinion. And that all the liquidity that's left is focused on AI and semiconductors. And I want to point out something that is pretty alarming. Semiconductors as a percent of the S&P 500 is 17%. That's one industry. And the stock NVIDIA market cap 5.4 trillion is bigger than the whole healthcare sector of the S&P 500. These relationships don't last forever. Semiconductors are also now 30% of the NASDAQ. So basically, the only game in town is semiconductors and AI stocks. And I've been talking to money managers. Most are underperforming. They can't keep up with their benchmarks. Some are chasing, some are sitting out. To be an active manager right now is a disaster because you have to basically overweight the very narrow part of the market that's working. Last year, the beginning of 2025, I did a couple podcasts where I said gold was going to go to 4,000. By the end of the year, it went to 5,500, I believe. After it peaked out, people were asking me, is this a parabolic top? Is it over? And I said at the time, no, I think it's going to consolidate, which is very healthy. And that's what it's done. I don't know how long that consolidation lasts, but I know when it's done, we're going to see $10,000 gold by 2030, which was, I also made that call at the beginning of 2025. So that call is intact. Central banks continue to accumulate gold. Commercial banks are accumulating gold because they made it tier one capital in July in the US. And we have voracious appetites in retail in India and China, and of course, throughout the rest of the Western world. So long-term gold fundamentals are good. That means that silver should follow eventually, but silver is way more volatile and is an industrial metal. So be careful. If our economic downturn call is correct, which I believe it is, silver could be hurt more. Gold is, I think, long-term fine. I did say on one or two podcasts when the markets were at their lows in the beginning of April, I said, I have a feeling that Trump is going to issue a ceasefire or try to negotiate and that the stock market could rally and we could see new all-time highs. Well, we've seen new all-time highs, but it's been a very unhealthy, concentrated new all-time highs. And I don't like calling crashes, and I'm not going to call one, but when this corrects, I think the speed of this is going to alarm a lot of people. And remember, though, you never crash from the top. We'll get a pullback, then a rally, and then if that rally fails, that's when you got to worry.